Hey everybody, Chuck Carnival, co-founder of FastGraphs, Fundamentals Analyzer software tool. And today's video is really one that I'm very passionate about. It represents a pet peeve of mine, but it also, I believe, represents some extremely important principles surrounding how you can be a successful long-term investor and what the key to investing success is. And I'm going to take the lead from some of the greatest investors who ever walked the planet and point out some realities here. You know, it really comes down to being realistic about your expectations, realistic about your abilities, realistic about what type of emotional makeup you have, how you can deal with investments. And then, later I'm going to get into being realistic about what you should be focusing on as an investor and what you shouldn't be focusing on. So let me start with one of my favorite Peter Lynch quotes, and beg your pardon while they read it so I get it correct for you. Renowned investor Peter Lynch put it very succinctly when he said, "In this business, if you are good, you are right 6 times out of 10, 60% batting average. You are never going to be right 9 times out of 10. So I think the very first thing that we have to kind of resolve ourselves to as investors is to recognize investing is not a game of perfect. We're going to make mistakes. Every investor has. No investor's perfect. Nobody can predict with perfect precision what the future is, because the one thing about the future that we can say with absolute certainty is that it's uncertain. But having said that, I also would simultaneously say that forecasting is the key to long-term investment success. We are obligated to do that. We can learn a great deal from the past, and I spend a lot of time in these videos showing you the past results of businesses, but you can only buy the future. And so if you're going to invest, I believe it's incumbent upon you to have some realistic expectation, and it needs to be a range of expectations of what you think the business is capable of doing on an operating basis, because we should all remember that in the long run, every stock, every business gets its value from the amount of cash flows it generates on behalf of its stakeholders. The more cash flow it generates, the more valuable it is, and vice versa. But in the same vein, Warren Buffett then went on to point out something that I think is also germane and critically point to the subject matter of this video. Warren Buffett said, "You are right because your facts are right and your reasoning is right. That is the only thing that makes you right." And what I'm really stressing here is if you buy a stock, Peter Lynch also once said, just because you buy a stock and it goes up doesn't mean you're right. Just because you buy a stock and it goes down doesn't mean you're wrong. This focus on short-term stock price volatility is really nonsense. We only get good information 4 times a year from companies when they do their quarterly financial reports to us. Everything in between that is noise. And in the short run, emotions will rule. We must remember the stock market's an auction. It's just like the auctions you see on TV. There's a guy, up there with a gavel at a podium, and he's going, "Hey, who's going to be sold?" to the man in the back room in the red shirt. It's an auction. You've seen the movie Wall Street. It's craziness. People got bids and asks. They're flying around with their hands. That's why stock prices fluctuate. I always say the good news about stocks, investing in stocks, is that they're liquid. The bad news about investing in stocks is that they're liquid. The liquidity is what creates the volatility, but the liquidity is also an advantage because, for example, if you compare it to investing in real estate, if you invest in, let's say, homes, and you need some money, you need to, have an emergency, a medical emergency, you want to buy a new car, well, you can't sell the kitchen. You either have to sell the whole house or nothing. With stocks, you can sell a piece of your holding and so on and so forth. But the key is, when you're making forecasts, you want to get the facts right. And if you get the facts right, you have to trust those. And the facts that I think you need to get right are the fundamentals. You got to have a reasonable expectation for things like earnings, cash flows, dividends, revenue, sales, what the capability of the business is. And then the stock price will take care of itself if you get those things right, as Warren Buffett pointed out. And then finally, I'd like to kind of, quote John Maynard Keynes, who said something that I think is extremely important to this, and this is the one that many investors really struggle with. John Maynard Keynes once said, when posed a question about a mistake he made, he said, "When the facts change, I change my mind. What do you do, sir?" And I think that's critical. It's Sergeant Joe Friday in the TV series Dragnet used to always say, "Just the facts, ma'am, nothing but the facts." And we need to try to deal with facts as much as we can as investors. But so, when the facts change, you also got to be willing to change your mind. So what I'm going to do here with this video, I'm going to go through a series of examples of mistakes that I've made. Some of them turned out to not be mistakes, by the way, at the end of the day. Others turned out to be mistakes. But what I want you to see is the importance of due diligence as an ongoing process. You don't just do your research, make a decision, get the facts, and then forget about it. You have to be constantly monitoring the facts to make sure that they stay current and that the companies continue to possess the characteristics you invested in them for in the first place. So let me start with one of my first examples that I think really clarifies this idea of making mistakes. I'm going to start with Carnival Cruise Lines. We all know what happened to cruise ships during COVID. On July 23rd, 2019, I wrote an article on Carnival Cruise Line showing it that I was making a purchase, and this is where I purchased it at a price of $46.20. A PE was 10.7. The dividend yield was 4.33%. The company was A- rated, only had 25% debt, and it was on a streak of growth. Cruise ships really were, no pun intended, cruising along at this point. The business was great. People considered it a great vacation, a great economical vacation, and analysts were very sanguine about forecasts. We were looking for good, strong earnings growth going forward on Carnival Cruise Line. Okay, but then, this was July of 2019. And, everything looked really, really good. But now let's go into March of 2020 and look at what happened once COVID hit. This is what Carnival Corp looks like today. As you can see, earnings estimates changed dramatically. This company has a fiscal year ending in November, and they're expected now, their 2020 number was a minus $7.47. Initially, when I wrote that article, forecast for 2020 was for $4.78 profit. Instead, they had $7.47 of loss. So the price collapsed. And again, if we look at that date, that was July of 2019. So let me find that here for you. This is June 28th. So that's about where I wrote that article. The price was $46.20. Here's 46.45. So you can see that Carnival's earnings collapsed. And what you also see here is the importance of fundamentals. The stock price collapsed with it. Then we ended up in 2021, we now have a forecast of $4.81. The industry's still struggling whether or not they're going to launch again. Now, there is some positive outlooks going forward. If we look at forecasting out to 2023 and 2024, the company is expected to make generate some earnings again. But these are very, very nebulous forecasts at this point because the reality of it is what we have is a great deal of uncertainty. Nevertheless, since that article was published, this stock has actually lost an total annualized rate of return of minus 26.6% per annum. That's devastating. The $10,000 or a $10,000 investment made on that original day would only be worth $5,550. You did receive some dividends, which have since been eliminated, but only partially, so you still ended up with a total negative rate of return of over 41%, 26.6% annualized. But there's a flip side to that story. As the estimates are beginning to be positive again, from the very, very bottom, this stock has recovered almost 100% off of its lows. It got down by March 31st, 2020. The price got down to $13.17. And they currently closed yesterday at about $25.85. So, there's been progress made on the price, but we still have a lot of fundamental issues going on. So Carnival turned out to be a mistake, but what happened was the fundamentals fell from what I called an event, COVID-19, something that hit and it came without warning. There was no premonition anyone could have had that this horrible disaster. Cruise lines looked like great stocks and great investments. So you've got to be prepared for that as an investor. These things do happen, and they can happen without warning. The next example I want to talk about is Meredith Corporation. This company is in the publishing business. They own magazines, Better Homes and Gardens, Parenting, etc. The business looked like it was doing extremely well. They made a big acquisition of Time, and EBITDA forecast and earnings forecast back when I wrote the article in March of 2020 looked absolutely excellent. This was initially when I wrote the article. However, I do want you to notice that the stock price collapsed even though the fundamentals really didn't change that much. So what actually happened with Meredith? Now, as time went on, as you looked a little further, by March 27th, Meredith, the forecast on Meredith changed. The very next day after I wrote the article is what it turned out to be. The estimates changed dramatically, and we started to look for very negative growth, if you will, in numbers. But I want you to notice something. This was a big surge in earnings growth here, and EBITDA even looked better. And the point is, the company slashed their dividend. They actually eliminated their dividend going forward here at this point. And so what we ended up with was a company whose, the estimates kept deteriorating as time went on, and Meredith eventually became a very, very poor investment because the business changed, the facts changed, and I changed my mind about the stock. Now, fast forward to current, and things continued to change. Like I say, the company eliminated their dividend. They offer no dividend yield. I don't think the company ever had to do that. One of the things that I was looking at with Meredith was operating cash flow. And here's a case where I felt that the company got overly conservative as a result of COVID. If you looked at their cash flow generation during this time frame, it was actually very, very strong. And even now, with estimates showing a little bit of weakness in fiscal year 2021, which ends June 30th, 2022, the stock, still had plenty of cash flow to cover their dividends. So I never felt that this company should have eliminated their dividend, and that really irritated me. I thought management overreacted. Now, the stock has begun to recover, just like we saw with Carnival Cruise Line, but the company has of yet reinstated their dividend, and I gave up on this stock. I consider this a mistake, but it was a mistake not because I got the facts wrong when I first looked at the stock. It was a mistake because the facts changed dramatically. And by the way, I did sell out of this stock, and I didn't get hurt as badly as the chart looks here, but I did get hurt. This was not one that was a positive experience for me or any of the people that I invested in Meredith on their behalf for. You're not going to be right, but 6 out of 10 times, according to Peter Lynch. You need to expect that, you need to recognize that, you need to be prepared to deal with that emotionally as an investor. The next example I want to share with you is Owens Minor, which is a healthcare distributor. I wrote an article on this stock on January 24th, 2018. And frankly, I thought the stock looked excellent. I didn't know very much about the company at the time. I was looking for good things to, blog about, to write about, and do videos on. And so I discovered Owens Minor. It was trading at a PE of 12, had a dividend yield of 4.7%. Company was BBB- rated and had less than 50% debt. And I thought it looked very attractive. There was a down year in earnings, so I was basically comfortable with understanding why there was this strong reaction. But future earnings looked really good, and the stock was already starting to recover. So I thought this would be a great time to write about it. It had a good dividend record, and it was really a good stock. Well, things changed, and they changed dramatically. And here's what Owens Minor looks like today. Now, the reason I find this one very, very interesting is because I think it really offers some great teaching moments. One of the things I said at the beginning of this video, that the stock market is an auction, and stock prices are very volatile, and they're also totally unpredictable. Nobody can forecast stock prices, but in the long run, stock prices will follow earnings. And this is a classic example. Historically, we see the relationship between earnings and market price being very strong with Owens Minor. When times when the price got below earnings, it reverted to the mean. When the stock price got above earnings, it reverted to the mean coming into the recession of '08. Then the stock price tracked it. We get these periods of, overvaluation, moving back into fair valuation. And then what happened was, instead of the earnings being strong in 2019 and 2020 and 2021, the company lost a big client and their earnings collapsed. They were also forced to slash their dividend from $1.03. Originally, they cut it to 86 cents and then down to a penny that I believe they're currently paying now. They technically have a dividend yield of about 0.03%, or really no dividend at all. But what happened is they rebuilt the business. This is a good business run by good people, and the real lesson here is not that I was right on Owens Minor, because my original article was written in January of 2018. So, looking at that here, it would be about right there. Okay, that's when I wrote the article. Remember, it looked, the earnings line was up here. Everything looked good. The stock collapsed. It fell all the way down to $2.71. From $21. That's a 87%. It was a 69.9% annualized loss. But now here's the point. This wasn't focusing on stock price. This was focusing on fundamentals, dividends and earnings deteriorating, and the stock price following suit, until finally the fundamentals began to turn around. And what we ended up with was a very good 2020. Earnings came in at $226. They're expected to grow 45% for 2021, and then flatten out or even drop a little bit in 2022 and 2023. But the reaction was the stock price now recovered dramatically. We had, the stock went from a low of $2.92 here up to $36. That's a 320% annualized gain since then. Now, the real trick here is, had looked at this stock, buying it, recommending it, or writing about it, or videoing it when I did, had you bought it then and just held it through this time, you would have made 20% a year. Now, very few of us, including yours truly, would have had the intestinal fortitude to do that. The lesson I want to get across here is that fundamentals matter more than price volatility. The price reacted appropriately to falling earnings here, and then it also acted appropriately when earnings began to recover. So there's my Owens Minor story. The next stock I want to talk about is one of my very, very recent ones. On February 5th of this year, I did a blog on Alpha Protec. It was actually a subscriber request, sort of. It was a stock recommended by one of the subscribers here in the YouTube channel. And this is what it looked like. This company is a very interesting little company that makes masks and shields or protective wear. They're a building products company. They're diversified. The company was actually a pretty good little stock. I mean, it had very consistent earnings growth. Doesn't pay a dividend. The performance on it was fair over the time, but then we had, because of COVID, this was a COVID speculation, we had this huge expectation for earnings growth going forward. And you can see, as I pointed out in the video I did, the stock originally surged dramatically, even incalculable, and then it was volatile. It fell, then it rallied again, then it fell again. And when I wrote the article, it looked like it was poised to be rallying again. It had already started to move. But then the facts changed. Now, all of a sudden, those estimates that looked so good just a few weeks ago, all of a sudden changed dramatically. And it had to do with, I think, the Biden administration talking about changes in how they were going to be purchasing masks and the government getting involved. But anyway, the bottom line is the company then reported earnings, and they gave weak guidance. And even though their numbers weren't too bad for the actual quarter, the guidance looked bad, and so therefore the analyst estimates changed dramatically. And now the stock has fallen to an all-time low in this recent time of $9.80. And I'm not talking about its all-time low, because obviously prior to 2019 it was a $4.44 stock. Today it's $9.80, but it still has a significant rally from once COVID started. But if I look at it from a forecasting point of view, even if I use the normal multiple, or the regular estimates, if this stock only traded at a 10 multiple, going forward, you'd have a chance to make double-digit returns. It's currently only trades at a 5 multiple. So if it stayed at a 5 multiple with these earnings estimates like they are, it would be a negative 22% rate of return. But if you applied just even a 10 multiple, which is significantly below what most stocks would trade at, you'd have a 13% rate of return. So the story's not over, but what has happened here, the facts have changed, and they've changed rather dramatically and rather abruptly. And when the facts change, I changed my mind. I think that's the real critical thing. Now, sometimes there are times when the facts change to your benefit. So with the next example, I'm going to take a look at Dick's Sporting Goods, a stock that I wrote about in April of 2018. Now, when I wrote this article, Dick's was trading at $32.15. The PE was 10, and that's about as low as it's ever been. The dividend yield was 2.8%, and earnings were expected to be moderately weak, by the way, for 2019, which ended in January, and fiscal year 2020 was expected to be a moderate growth of about 5%, followed by 2%. But here's a case where COVID came. This stock was a retailer, and the market price got hit very hard. But interestingly here, even though it was a retailer, the fundamentals changed, and they changed dramatically to the better. Let me show you. Here's what Dick's looked like today. Now, initially, we were expecting, rather weak earnings in here, and the company actually ended up with much better earnings than the analysts were expecting. And then for fiscal year 2021, or 2020 you could call it, which ended January 31st, 2021, earnings surged by over 66%. The company got, wise to, the internet, even though people were locked in and their stores, a lot of their stores were closed or people weren't traveling and shopping, they were able to still do a great deal of business. In fact, they had this huge surge in earnings, and even though the stock initially fell, it was $32 a share when I originally wrote about it. This is at $49 a share, so it peaked out there. It actually fell, all the way down from $49 a share down to $21 a share, and that was virtually a 57% negative drop in value, and it was an annualized rate of return of 96% because it happened in a very, very short time frame, from December 2019 to March of 2020. So it was annualizing like at almost 100% loss. But then look what happened as the market began to realize that the fundamentals were not collapsing, they were actually improving. The stock now has gone up 260% off of its lows, averaging over 274%. If we measure this just from the time that I wrote the article, which was about a $32 price, that's about as close as I can get with the current data I have. In the short time I've owned this would be annualizing at 70%, or it would have gone up 124%. But this is why I don't trust stock prices. The price originally collapses. The fundamentals were strong. Fundamentals are much more important than stock price. So, you aren't going to have a perfect record as an investor. You are going to make mistakes. It's important to learn from your mistakes. It's important to recognize your mistakes as early as you can. And I'm not talking about reacting to stock prices. I'm talking about looking at the fundamentals of the business. And when they change dramatically, that's when I change my mind. But if the fundamentals remain intact or even improve, like we saw with Dick's, then I tend to sit tight and hold on because I trust the orange lines on these graphs. The business results is what the orange lines represent, more than I do the black line, which is the volatile stock price. Hope you enjoyed this. This is Chuck Carnival saying thanks for watching. Look forward to talking to you again real soon. If you like the video, give me a like, of course. Ring the bell. And if you haven't already done it, subscribe. This video is more about some very important principles of investing and how you should emotionally deal with investing. Thanks for watching.